So you probably keep seeing in the news that the stock market keeps reaching new all-time highs. That's super exciting to me. I don't know about you. I'm ecstatic. But I feel like a lot of people see this and don't know what this means. So basically when people say the stock market has reached all-time highs, they're referring to the S&P 500. The S&P 500 is an index that tracks the 500 largest companies. So think your Microsoft, Amazon, Apple, a lot of the big names you know. So if the S&P 500 is at record highs, like it hit today, that means that the stock prices of these companies is the highest that it's ever been historically. So that's really good for people who are invested in these names, because it means that whatever price they bought those stocks at before, they're the highest they've ever been today. And that kind of goes with the whole idea of being in the stock market, right? You buy a stock at a price, hold it, wait for it to grow in value, and eventually sell it at a higher price for profit. But the really cool thing is today's all-time highs could be a fraction of what we could see in a year, 2 years, 3 years, 5 years. I mean, the stock market shows this historically. It might move like this, but it's always gone up. And although we have crazy times like COVID and pandemics and recessions and political tension, it just goes to show that the market is always resilient, at least it always has been, which I think is really cool. Anyways, I'm gonna go buy a Big Mac in celebration because I love Big Macs. Happy Thursday.
And like she mentioned, stocks can be going down in value during pandemics, during recessions, and any major fear time in the market. That's usually the best time to be investing. Everyone starts freaking out when stocks are going down in value, but gets so excited as stocks are going up. But the best times to be buying in the stock market are when stocks are hitting new lows. That's the best time, because if you're a long-term investor, you invest whenever the stock prices are low, and then you wait it out long enough until, like she mentioned, generally over time the stock market goes up, and you reap the benefits of buying whenever everyone was getting out. Old saying by Mr. Warren Buffett, the legend himself: be fearful when others are greedy and greedy when others are fearful. Meaning, be cautious when everyone's praising, sharing their screenshots of how much they made in the stock market, and be buying heavy when everyone's scared, freaking out because stocks keep hitting new 52-week lows. Now, speaking of the stock market and trying to figure out how to even start investing or which stocks you may want to invest in, we all know investing.com, right? Well, I want to talk about their flagship product, Investing Pro, because this thing is seriously powerful if you're into stocks or long-term investing. With Investing Pro, you get real data and expert level analysis all in one place. When I'm analyzing a company, I can instantly see its fair value, financial health, and what analysts think it's worth, instead of jumping between 5 different websites. My favorite feature is ProPicks AI, which highlights stocks based on proven strategies like Quality Compounders and Energy Elite. It's an easy way to find solid companies that might be flying under the radar, or as they say, find trades others can't. You can also use the screener to filter by fundamentals, growth, or undervalued stocks, which makes research way faster. Now, right now during their Black Friday sale, you can get up to 60% off, but wait, it gets even better. You can also get my exclusive 15% stacked on top of that when you click the link to sign up down below in the description. Again, guys, just click the link down below in the description to grab your subscription and start using Investing Pro today. The best deal of the year won't last long.
If I were 32 and had $5,000 to invest in the stock market, this is exactly what I would buy and exactly how I would buy it. And guess what? I'm 32 years old. I just hit 100K in investments on an average salary of $42,000 a year and have $5,000 to invest. So let's go. The first thing I would do is open up my app for my broker. I use Vanguard, so I'm opening up my Vanguard app. Now, if I had a 401k or a 403b, I would be investing at least up to my employer match first. But I just quit my job, so I'm putting all of this money into my Roth IRA. Now that I've opened my Vanguard app, I'm going to click transact, then click contribute. Next, I select a funding source. I've connected my broker to my bank, so I select my bank account. I enter that I'm contributing $5,000. I click preview order and then submit. Now that I've contributed this money, I have to invest it. I have to buy stock. So I go back to the homepage and click transact again. Now I select my Roth IRA account and what I want to invest in. I'm going to buy $4,000 worth of VTI and $1,000 of VXUS. In order to buy $4,000 worth worth of VTI. I'm going to enter VTI under symbol where it says get quote. Then I scroll down, click buy, click dollars, and enter $4,000. Then I hit preview order and submit. Then I just repeat that process for $1,000 worth of VXUS. Happy investing.
I mean, that girl is spot on. Guys, if you have never invested in your life and you want to start investing today, right there. That's how you do it. And I love the fact that she mentioned this, because this is one of the most common mistakes people make when it comes to investing and putting money into their account, right? Especially with Roth IRA investors for some reason. People who open up a Roth IRA get this mistake all the time. I hear it all the time. And that is whenever you transfer the money from your bank account, like your checking account, to the Roth IRA, you still have to invest the money once it transfers inside the Roth IRA. A lot of people think that when you transfer the money from the checking account to the Roth IRA account, it's good to go. It's invested, but that's not the case. You still have to pick out your investment. I love the two investments that she mentioned. I'm invested also in those ETFs, and I really think you can't go wrong with them. Props to her.
We'll just buy a Vanguard no load S&P 500 and hold it and don't ever sell it.
There you go. And the more money you have, just keep reinvesting and reinvest the dividends, and over time you'll do okay. Which is really my whole 401k. You know what I'm saying?
It's sad to say, but like at the end of the day, unless you're a professional investor that's on it every second and like you just really know what you're doing, it's been proven. Even the most successful hedge fund managers can't beat the S&P over the long term, and especially when you're including the fees they charge, the commissions, the tax advantages of buying and holding and reinvesting dividends. So you're going to end up much, much better off. And it's been mathematically proven. You simply buy the S&P and just hold it for 30 years.
You heard it from the Wolf of Wall Street himself. Guys, investing does not have to be that complicated, okay? Now, like, yes, if you want to go out and buy single stocks and crypto and all this other stuff, like, by all means, go do it. I do it myself, but understand this, majority of my investments in the stock market are invested in ETFs, standard index funds, like he says, that tracks the overall S&P 500 or the overall entire US stock market. It's the easiest way to set it, forget it, never mess with it. And again, like he mentioned, a lot of people can have a very hard time outperforming the S&P 500 over the long term. Now, in these high-flying markets, you know, it's pretty easy to outperform the S&P 500, but to do that on a consistent basis, year over year for a 10, 20-year track record, it's practically almost impossible. So you're better off just buying the market, set it and forget it, have an automatic withdrawal coming from your checking account, automatically investing into that ETF that you choose, and set it and forget it.
The stock market is near all-time highs again, and the biggest mistake I see people making is that they don't invest because they would rather wait to see if it drops a little first. Now, this is actually a behavioral bias because the S&P 500 spends about 8.3% of trading days at all-time highs. That's roughly 21 days per year when it's at a record level. New all-time highs are usually followed by more all-time highs, and if you're not invested on the big days when the market is up, you actually miss out on a lot of the gains. If you miss just 10 of the best days in the market in the past 30 years, you could erase your gains by 54%. Missing 20 days will cost you 73% of your total gains, and missing 30 days will result in 83% less. Paying a price no one has ever paid before definitely creates psychological resistance, but that's exactly when disciplined investing matters most. So to be a better investor, you want to simply dollar cost average, which means that you should be investing a certain amount of money at a regular interval of time, and that way you take away all the emotion out of it. Follow me for more tips.
More spot on advice, guys. I mean, that's exactly what I do with my accounts. Now, my retirement accounts, I do a little bit differently. Those tend to be lump sum investments. So what I do is whenever I talk to my tax guy and I got to do all the things I got to do in order to invest in my retirement accounts, I transfer that money to my retirement accounts, and then I just do a lump sum investment into my index fund of choice, or ETF, which is usually VTI or VTSAX, sometimes VU as well. But generally what I'm doing is I transfer that money over as a lump sum. Let's say it's $7,000 going into my Roth IRA. That day I transfer it over and the money shows up, I'm investing that full $7,000 inside the S&P 500 no matter where it's at. I don't care. The day I transfer the money, it may be the highest day in the market, I'm investing it. Because I'm not touching that money until I'm 59 and a half. That's another 25 years. In 25 years, I don't think I'm really gonna be worried about where the stock market price was in 2025. But whenever it comes to my taxable brokerage account, I'm doing exactly what he was saying as dollar cost averaging. Every single month, I'm investing in my ETFs that make up my taxable brokerage account, and I'm investing that at the first of the month, every single month, no matter where the stock market's at. I'm putting money in because I don't want to miss out on the growth. I'm not trying to time the market. Time in the market always beats timing the market.
So I made $90,000 this year off of 3 stocks. How did I do it? So technically they weren't stocks, they were ETFs. I will share them with you, but first I need to break down what an ETF is. An ETF is basically a basket of stocks that track a specific sector or industry. So let's say you wanted to invest in tech and you didn't know which stock to buy. You could just buy an ETF that tracks an entire tech industry or subsector. And that way you get exposure to all the stocks. That way, if one stock flops and the others pop, you're still winning and making money. Now, the ETFs I used, TQQQ and QQQ and VOO. QQQ and TQQQ track the NASDAQ and VOO tracks the S&P 500. TQQ is leveraged and is responsible for the vast majority of the returns I made in that 90K I mentioned. How are TQQ and QQQ different? Well, TQQQ is leveraged, meaning that if the NASDAQ goes up 5%, the TQQQ will go up 15%. But it works on the other side as well. If it goes down 5%, the TQQQ will go down 15%. So yes, high risk, high reward, but if you catch it in a bull run like I did, the returns can be massive. Oh, and if you want to know how I did this tax-free, feel free to leave me a comment.
Yes, he's exactly right. I will say this very, especially to my newer investors, I caution you on leveraged investments, leveraged ETFs. I don't personally invest in them, but like he said, if you catch them at the right time, you can make a lot of profit in your investments. I just say, do it wisely, be cautious, and just know what you're getting into. If you don't understand it, don't invest in it. Now, the point I wanted to make for this video, because I'm gearing this a lot towards my beginners in the stock market, is the best way to get started is investing in an index fund or an ETF that is focused on a sector that maybe you want to invest in. For example, one ETF I have in my taxable brokerage account that is in a sector that I'm bullish on for the next, 10 years or so, 5 years or so, is a ETF called SMH, and it focuses around companies in the semiconductor industry. So that is an ETF I buy personally. Now it doesn't make up a very large portion of my overall taxable brokerage account, but it is at least in there enough to where I'm exposed to that industry because I am bullish on the semiconductor space over the next 5 years or so. Now, the other and last point I wanted to make with this video, and I can dive into more detail in future videos if you guys are interested in this, but when it comes to stocks, like single stocks, I'm not opposed to you guys investing in that. I just want to say I caution my beginners getting started with stocks and not fully understanding what they're doing. I think the best way for long-term growth is just buying an S&P 500 index fund or ETF, sitting on it, investing in it every single month, and never looking back. Now, if you want to be a little more active or you want to get into, options trading, which is also some stuff that I mess with, let it be a fun portfolio, right? Let it be a fun portfolio. I have one that I have a lot of my single stocks in and that I do my options trades in as well. But let that be separate from like your long-term solid base, just, set it and forget it account. Open that up in a separate account that you can kind of have fun with. And that way you're also not going to get so hurt if you maybe do have some major losses in that account. But as you learn, as you'll grow, you'll understand more of how you want to navigate yourself in the stock market. But I hope this was a very good intro or helps you get a little bit of a better understanding of how to handle and invest in the stock market so that you can reap the returns and hopefully build your wealth as well.